June 2009, June 2020, and June 2025. Each marked spectacular V-shaped recoveries on the US stock market. In all three cases, the S&P 500 climbed by over 20% within 55 days, something that has not happened at any other point over the last 15 years. In both 2009 and 2020, the stock market rally continued to power through, climbing an additional 20% over the subsequent 80 days. So far, 2025 has already been a very strong year for us. We've ridden the bull market with our members at Bravos Research, locking in multiple double-digit wins on various tech trades, and overall keeping our losses very limited. You can see all of our closed trades for the second quarter of 2025 right here. All of our winners and losers are on our homepage, by the way. And when we overlay the price action of the 2009 V-shaped recovery on top of the stock market rally that we're experiencing today, we see a striking resemblance. If we're following a similar path to the 2009 or 2020 V-shaped recoveries, it could make the returns that we've had so far in 2025 look like child's play. It's in these conditions where we can really see some incredible performance with our trading strategy. Before we look at whether this is actually a plausible scenario, I want to wish you all a happy 4th of July. Like every year, we're doing a major sale on our service in order to celebrate. This provides a discounted price to access all of our trades and a step-by-step blueprint of our entire trading strategy week by week. All of that for a ridiculously low price. So if you've been thinking about joining our community, now's your time, because if this is what's in front of us, it could be that we're on the edge of some major trading opportunities. Let's start by looking at the level of panic that we saw at the bottom of the crash in April of 2025 to see if we're actually in a comparable situation. This is the volatility index of the S&P 500, giving us a great idea of how much panic the market is experiencing at any given point. And we can see this index spiked above 40 at the height of the panic in response to Donald Trump's tariffs. This was a level of volatility on the US stock market that had not been seen since 2020, and before that, 2009. Both of these spikes in volatility occurred right before those two V-shaped recoveries, just like today. Now, although we did see volatility spike to similar levels to 2009 and 2020, at the heart of these panics, this index spiked to much higher levels than what we saw in 2025. And that brings about a major difference between 2025 and these two episodes. In both 2020 and 2009, the US economy was in the middle of an economic recession, which was not the case in April of 2025. The unemployment rate in 2009 and 2020 was at high levels, going above 10% in both of these cases. And the Federal Reserve responded to this by lowering its interest rate down to 0%, in addition to injecting large amounts of liquidity through quantitative easing in order to stimulate growth and get the economy out of a recession. In 2025, however, the unemployment rate is at 4.2%, which is the lower end of the historical range, and although the Federal Reserve has lowered interest rates a little bit over the last year, they've generally kept them at relatively high levels in order to avoid seeing inflation make a comeback. At the same time, they've been reducing the size of their balance sheet consistently since 2022 through quantitative tightening. So in other words, they've been gradually pulling liquidity out of the system instead of injecting it like 2020 and 2009. Needless to say that the macroeconomic situation is substantially different today to what it was in both of these instances. Still, just because we're in a different situation doesn't mean we can't get similar results. S&P 500 earnings have seen multiple large upwards revisions in recent weeks for the first time in years. This comes after 15 consecutive weeks of large downside earnings revisions fueled by fears that tariffs would freeze the economy and cause a slowdown. But overall, it seems US corporations are actually coming out on the other side of these fears stronger. In fact, this is the largest streak in upwards S&P 500 earnings revisions since 2020 and 2021. The strong earnings recovery coming out of the pandemic right here, after the very steep downside earnings revisions during the recession, the very strong earnings recovery in 2020 coming out of the pandemic is in large part what drove the exceptional stock market performance. And the same thing can be said about 2009, where stocks also experienced significant upwards earnings revisions following the great financial crisis that fueled the V-shaped recovery that we discussed earlier. So the upwards earnings revisions that we're seeing today are a great start for the stock market to sustain strong returns heading into the end of the year. But unfortunately, it's unlikely that we'll will experience something that is as intense and as powerful as the earnings recoveries from 2020 and 2009. Currently, S&P 500 earnings are growing at a roughly 10% per year, which is quite healthy and can drive some pretty good market returns. But when you compare that to the level of earnings growth that companies experienced in 2009 and 2020, in both of these cases, earnings reached an annual growth rate of 30 to 40% as corporations were recovering from severe declines in their earnings during the recession and were also benefiting from very easy financial conditions provided by the Federal Reserve, as mentioned earlier. So during the 2020 and 2009 recoveries, the stock market experienced 3 to 4 times more earnings growth than we are experiencing today. So the US stock market is undeniably in a very different situation to 2009 and 2020, despite having just experienced a very similar rally. So we can't really use these as relevant case studies to understand the market behavior looking forward. But if we zoom out just a little bit further, there is one historical episode that we can use, however, and that is 1998. Here, the stock market also experienced a steep decline that was followed by a very sharp recovery, quickly taking the market back to all-time highs. In fact, the S&P 500 also posted over a 20% return within 55 trading days, making these 4 rallies that you see here the only 4 episodes going back to 1998 where we've seen this happen. In 1998, S&P 500 earnings were growing at a rate of 10% per year, very similar to today. The unemployment rate was low, just like today. The Federal Reserve was keeping their interest rate at relatively high levels, just like today. The internet boom was gaining momentum, just like the AI boom is gaining momentum today. So both from a market strength and macro standpoint, these 2 episodes are strikingly similar. If we overlay the price action of the 1998 recovery onto today's V-shaped recovery, it's also quite an incredible match. Now, although in the short term, we think the odds of seeing a small pullback over the course of the next month is quite high, ultimately, if the S&P 500 follows the same path as it did in 1998, it could reach 7,000 points by December 31st. We happen to think that this is quite a plausible scenario. We're going to be looking to ride this bull market and hopefully outperform the index with our clients at Bravos Research. If you want to take advantage of that with us, make sure not to miss the 4th of July discount that we're doing on our service by clicking on the link down below. Thank you for watching.